AdSmart was established on 1 April 2015 with a financial year end of 31 March. It's always important to know when the financial year end is. The company specializes in the placement of billboards and maintenance of advertising billboards. AdSmart is not registered for value-added tax. Since its inception date, AdSmart signed contracts with each of its advertising clients. One of its advertising contracts contain, amongst others, the following terms and conditions. Number 1. At the commencement of the contract, signed at 1 June 2015, a client paid a refundable once-off fee of R180,000 for the right to advertise for an 18-month period. Now guys, any normal financial year is only 12 months. So obviously, if it is a contract for 18 months, it is going to be over more than one financial year. Our financial year ends on the 31st of March. So if I've entered into the contract, so the 1st of April, May, so 2 months after the beginning of the financial year, we have entered into this contract. So that means that there's only 10 months left from the 1st of June up to the end of March of the next year, which falls into the current financial year. The other months that's left is going to be, it's 10 months, so there's an 8-month period that's going to fall into the next financial period. Good. AdSmart's client also pays a monthly maintenance fee in advance to AdSmart. This is used to maintain the billboards of the clients. AdSmart prepares detailed estimates of the maintenance costs for each contract in order to ensure that a reasonable profit is earned. Maintenance costs are incurred evenly over the period of the contract. So that means whatever they pay this month for maintenance costs, they're going to pay next month for maintenance costs. So it is the same amount that they have to pay on a monthly basis. Now remember, this also, there is a right to advertise, and then there is a monthly maintenance fee. So there are two things here come into play. Now, for the monthly maintenance fee, there the client pays as he is using the service. So it's evenly through the year. There's no prepayments. He should pay as he uses the service. AdSmart's clients also charge with the design and setup fee for billboards, and this is invoiced separately upon completion of those billboards. So that is the third thing that he has to pay, but that he has to pay upfront. So on the completion, when that billboard is completed, he has to give us the money, and then we're going to display the billboard. AdSmart has a new accountant, Mr. Smarty Pants, and he contacts you for advice on how to treat the 18-month contract fees mentioned in number 1 above. So it's all about that one. AdSmart's first year end is around the corner, and Mr. Smarty Pants is unsure if the accounting treatment by the previous accountant was correct, as she only passed the following journal upon receipt of the fees from the client. Again, it's about 180,000. Contract started on 1 June 2015, 8-month period. Good. Now, they received a refundable once-off fee. What does a refundable once-off fee mean? It means if they're not going to perform under the contract, then they will have to get their money back. So what did the accountant do? She debited bank with the amount that they've received, 180,000 Rand. You can't argue with that entry because that is a fact of the matter. Please look here. It's a journal entry, and there is a statement indication after the account which was affected in the journal entry. P&L is statement of profit or loss. And then she recognized the full 180,000 Rand as income in the books, regardless of the fact that this contract is going to go over the financial year end, 8 months into the next financial year end. So it is required from you as Smart's financial advisor to write a memo to Mr. Smarty Pants to advise him on the appropriate definition in terms of the conceptual framework for the 18-month once-off fee mentioned in number 1 above for the financial year ended 31 March 2016. Now, read your questions carefully. The first thing that and that was underlined here, but I'm not always going to underline that. You have to write a memo. Now, guys, if you have to write a memo, then you have to write a memo. Because if you don't write a memo, you are going to be penalized for the fact that your answer is not in a memo format. Good, so basically what we have to talk is about this journal entry here. And obviously the issue on hand is income. What portion of that income am I allowed to recognize in this year? And that portion, that 8 months of income that I'm not allowed to recognize in the current financial year, what do I do with that? Because I've already received the money. So the short answer for the second question is that I have to defer that portion of the income to the next financial period because I'm not allowed to do that. Now, if you look at this journal entry here, debit bank credit income, I have recognized too much income. So out of an accounting perspective, how am I going to rectify that? Guys, I'm going to debit the income to reduce that, and I'm going to credit income received in advance. And income received in advance got a credit balance, and therefore it must be a liability. So income received in advance will be credited with that portion of the income that I'm not allowed to recognize this year. The question doesn't ask you to talk about the underlying assumptions on which financial statements are based on. But here clearly, what is the underlying assumption that comes forward out of this question? And that is the accrual principle, because the accrual principle says I'm only allowed to recognize income if it is earned and not when the cash is received. Okay, let's go back to the question, and they ask us here to write a memo on Mr. Smarty Pants, and they want you to write a definition in terms of the conceptual framework. So basically, it's all about the definition of an income and a liability. Now, if I'm going to write a memo, I have to address the memo to somebody. So I'm going to address the memo to Mr. Smarty Pants. I must tell him from whom he's going to receive that memo. Now, here it is very important, guys. You will not put the Peter Pan or whatever your name is. It must be a name, and this comes from SAICA, that is an unrecognizable name. So you can write F advisor, S student, things like that, but not your real name and your real surname. Subject, what is this memo all about? It's all about the accounting for billboards, and what is the date of the memo? 11 April 2016. And then because it's a memo, I'm going to start with, Dear Mr. Smarty Pants. The second portion of your memo is going to be about the issue you're going to discuss, which we're going to do now, and then you're going to close off with kind regards, F advisor. Now, if your memo is in this format, well, that can earn you, say, from 1/2 to 1.5 marks. So if you don't have this format, you can be penalized with about 1 mark because you didn't adhere to the format. Okay, now let's see what is the issue on hand. The first issue on hand is what is the definition of a liability. We said that accounting-wise, we're going to defer that portion of the income that we've recognized to a later stage. And in order to do so, we're going to create a liability in our books. Now, a liability is a present obligation of the entity to transfer an economic resource as a result of past events. Now, let's look at the application on this side. We say that for a present obligation to exist, it must be an unavoidable commitment that the entity has to honor. So at year end, all services have not yet been completely rendered. Therefore, there's a present obligation. I've entered into the contract. I've undertaken to do this work over the next 18 months. So there's a present obligation that the entity has. It is an unavoidable obligation. He doesn't have any choice. He has to do that. And it is legally enforceable because there is a contract in place. AdSmart has an obligation to render that advertising services over 18 months period. What's the economic resources that were transferred? Now, AdSmart has to render a service. Now, in order to render that service, they are going to make use of their staff resources and they're going to make use of everything that they need in order to place the advertisements. If they don't use that and if they don't honor the terms and conditions of the contract, they will have to pay back the money. So if they're going to pay back the money, the economic resource that we're talking about is their cash resources that is going to decline. In both instances, whether they're actually going to adhere to the contract and or if they're going to go back on the contract, there will be economic resources that is going to decline. That's going to be transferred. As a result of past events, the agreement to render the service contract, this was the receipt of 180,000 Rand, took place on the 1st of June. Good. Good. The next thing that we have to discuss is income. What is the definition? Income is a decrease in assets or increase in assets or decrease in liabilities that results in an increase in equity other than those relating to contributions from holders of equity claims. Now, was there an increase in assets? Yes, there was. We received 180,000 Rand, so cash was received, thus assets has increased. That result in increases in equity. Now, money was received, so assets increased, liabilities stayed the same, so therefore equity must have increased. Income was earned and cash was received for the service rendered during the accounting period, so there was an increase in equity. Other than those relating to the holders of equity claims, they received it from an outside party, not from the owner of the business. So therefore, the income portion that we can recognize for the current period is adhering to the definition criteria of income. Good. Then we have seen that the recognition criteria of a liability has been met for that period of income that we have to defer. The recognition criteria for income has been met for that period that we've earned the income. Now, so the first criteria that recognition can take place has already been met. So there are two more criteria issues surrounding recognition. The one being relevance and the one being faithful presentation. Now, in relevance, remember, is it about the uncertainty about the existence of the element? Number two, it's uncertainty about the flow of economic resources. Faithful representation is all about the uncertainty surrounding the measurement of the element that we want to recognize. So let's have a look about relevance. The actual amount earned during the financial period should be recognized as revenue in the statement of profit or loss. Now, there's the important word. Amount earned. I haven't earned the full 180,000. I only earned a portion of that. The amount received in advance. So the amount earned, that would be revenue or income. The amount received in advance, that's the other portion of the coin, that should be shown as a current liability because an obligation to perform under the contract is still in existence. There is no uncertainty that the obligation exists. So the first one is about the uncertainty of existence. So there's no uncertainty. It's very clearly set out in the contract. Also, there is no uncertainty that the inflow of economic resources has taken place. So we said the other one is all about the uncertainty surrounding the flow of economic resources. AdSmart already received the money and can therefore recognize the income. AdSmart also has to fulfill its contractual obligation to render the service, outflow of human resources, or pay the money back, which will constitute an outflow of cash resources. Now, faithful representation, it's all about the uncertainty around the amount, the measurement, in other words. Let's get another color here. Uncertainty around the amount of the liability and the amount of the income that we are allowed to recognize. We had a contract. Nothing can change with a contractual amount. Nothing can change with under the contract with the duration of the contract, and therefore it's quite easy for us to determine what is the amounts involved that we have to disclose in order to ensure that the financial statements are faithfully represented. Then, our conclusion. The 80,000 rand of income received will be recognized as a liability at year end, and that equals the 180,000 divided by the 18-month period multiplied by the 8 months that we're going to defer into the next financial period. A total of 100,000 rand complies with the definition of income, and that is the portion that we've already earned. So that's 180,000 divided by the 18 months multiplied by the 10 months of the current year that we've already done the work for. And then I'm going to close it off. Yours sincerely, F Advisor.